Okay, so you want to own a watch company. Not just any watch company. You want the kind that makes people whisper when they see it on a wrist. The kind where a piece of steel and sapphire crystal, smaller than a deck of cards, sells for more than a house in most American cities. You picture the boutique on Fifth Avenue, the waiting list with your name on it, the quiet nod of recognition from a stranger who clocks your wrist before your face. Here's what nobody tells you before you get into this business. The watch you're dreaming of costs about $400 to build. It sells for $38,000. And there's a 2-year waiting list to buy it, even though the company could make more of them tomorrow if it wanted to. That's not a mistake. That's not inefficiency. That is, by design, one of the strangest and most profitable business models on earth. So why would a company deliberately refuse to sell you the thing you're begging to buy? Why does scarcity make more money than abundance? And how does an industry that makes an object with zero practical function in the age of smartphones somehow generate over $60 billion a year? Stick around. Because the answer to that question will change the way you look at every luxury brand you'll ever encounter. Let's start from zero. A watch, at its most basic level, is a machine that counts. It counts the swing of a pendulum, or the vibration of a quartz crystal, or, in the case of the watches we're talking about today, the unwinding of a tightly coiled spring. That's it. That's the whole function. Tell you what time it is. Your phone does this for free. It does it more accurately, using a signal bounced off a satellite orbiting the planet at 17,000 miles an hour. So mechanically speaking, the wristwatch has been an obsolete technology since roughly 2007. And yet, in 2023 alone, the Swiss watch industry exported nearly $27 billion worth of watches. Not sold domestically. Exported. Shipped out of a country of fewer than 9 million people to buyers all over the planet who wanted a machine to tell them something their phone already knew. Here's the first thing you need to understand, and it's the key that unlocks everything else in this story. A luxury watch was never really in the business of selling time. Think about a bakery for a second. A regular bakery sells you bread because you're hungry, and bread solves that problem efficiently. But imagine a bakery down the street that takes 6 weeks to bake a single loaf by hand, uses flour milled by a third-generation family in a village in France, and charges $400 for that loaf. Nobody is buying that bread because they're hungry. They're buying a story. They're buying the fact that almost nobody else has that bread. They're buying into an idea about themselves. That's the entire luxury watch industry in one sentence. It sells identity, using time as an excuse. Now here's where it gets interesting, because the business model underneath that idea is far more calculated than it looks. Let's talk about how these companies actually make money, starting with the basic mechanics. A mechanical watch movement, the actual engine inside the case, can be manufactured for somewhere between $50 and $800 depending on complexity, if you're a company with real manufacturing scale like the Swatch Group. Add a case, a dial, hands, a strap, packaging, and you're often looking at a total production cost somewhere between $300 and $2,000 for what the industry calls an entry to mid-tier luxury piece. That same watch might retail for $8,000. Gross margins in the luxury watch business routinely sit between 60 and 70%. Compare that to a car dealership, where margins hover around 5%, or a grocery store, where you're lucky to clear 2 or 3% on a sale. The watch industry isn't just profitable. It's one of the most profitable manufacturing sectors that exists. But here's the problem. If margins are that fat, why doesn't everyone just flood the market with product and make even more money? This is where the story stops being about manufacturing and starts being about psychology. Think about a nightclub. Not the club itself, the line outside it. A club that lets everyone in immediately, no line, no velvet rope, feels cheap within a month. But a club with a bouncer, a rope, and a tour weight becomes the place everyone wants to be seen entering. The weight isn't a flaw in the business. The weight is the product. Rolex understood this before almost anyone else in the 20th century. Rolex produces, by most industry estimates, around 1 million watches per year. That sounds like a lot until you realize the company could likely produce 2 or 3 times that number with its existing factories in Geneva and Bienne. Demand for certain models, the steel Daytona being the most famous example, so dramatically outstrips supply that authorized dealers maintain waiting lists stretching past 5 years for some references. And here's the number that should stop you in your tracks. A steel Rolex Daytona has a retail price around $14,000. On the resale market, in the weeks after someone finally gets their name called at the boutique, that same watch is sold for over $30,000. Nearly double, instantly, for a product that never left the original owner's hand. That's not a coincidence. That's controlled scarcity, executed at industrial scale. This is where things become interesting, because Rolex isn't even a public company. It's privately held by a foundation, the Hans Wilsdorf Foundation, which means it never has to answer to shareholders demanding higher output or quarterly growth. It can simply decide, every single year, to make less than the market wants. And every year, that decision makes the watches worth more. Imagine if a car company deliberately built 40% fewer vehicles than people wanted to buy, on purpose, forever. That's Rolex's actual strategy. Underbuild the demand, permanently. But that's only half the story, because scarcity alone doesn't explain why a Rolex is worth more than a nearly identical watch from a lesser-known brand, with the same materials, and the same mechanical precision. That gap is called brand equity, and it might be the single most valuable asset in this entire industry, even though you can't touch it or put it in a warehouse. Here's an analogy. Picture 2 identical bottles of water. Same source, same purity, same plastic bottle. One says Aqua on the label. The other says Evian, bottled from the French Alps, marketed for decades as pure and prestigious. People will pay 3 times more for the second bottle, for water that came out of the same kind of ground. The water isn't the product. The story stamped on the label is the product. Watch brands spend enormous sums building that label. Patek Philippe, one of the most storied names in the industry, ran an advertising campaign for over 2 decades built around a single phrase. You never actually own a Patek Philippe. You merely look after it for the next generation. Notice what that sentence does. It doesn't mention accuracy. It doesn't mention craftsmanship. It sells inheritance. It sells legacy. It sells the idea that this object will outlive you and connect you to people not yet born. That's not a marketing slogan. That's a religion printed on a magazine page. And religions, as it turns out, are extremely good business. Now let's talk about capital, because building a brand like that from scratch is brutally expensive, and this is where most people's dream of starting a watch company quietly dies. Think of it like opening a restaurant, but the fanciest restaurant imaginable. You don't just need a kitchen and some tables. You need decades of reputation before anyone believes your food is worth $1,000 a plate. A luxury watch brand needs the same thing: heritage, craftsmanship, celebrity association, and enormous, sustained marketing spend, often for years before turning any real profit. LVMH, the conglomerate that owns Tag Heuer, Hublot, and Zenith, spends an estimated 30% of luxury division revenue on marketing and brand building in a typical year. That's not an exaggeration for effect. Roughly 1 in every $3 a customer spends is essentially funding the next customer's desire to buy in. Starting an independent watch brand from nothing, hiring master watchmakers, developing proprietary movements, building a boutique presence, can require anywhere from $5 to $50 million of patient capital before the brand achieves any real cultural cachet. And even then, most fail. The graveyard of failed independent watchmakers is enormous and largely invisible, because failure in this industry doesn't make headlines. It just quietly disappears. So now comes the difficult part. Even if you clear that mountain of capital, even if you build a brand, you still have to survive an industry that has nearly destroyed itself at least twice in the last 50 years. Let's talk about the first real case study, and it's the most important crisis in the history of this business. In the early 1970s, the Swiss watch industry employed around 90,000 people and controlled roughly half of all watch sales globally. Switzerland was synonymous with watchmaking the way Detroit was synonymous with cars. Then Japan entered the fight. In 1969, Seiko released the Astron, the world's first quartz wristwatch. Quartz movements use a tiny vibrating crystal powered by a battery instead of hundreds of tiny mechanical parts wound by hand. They were more accurate, dramatically cheaper to produce, and required almost no specialized craftsmanship to build at scale. Imagine you run a family bakery that's been hand-kneading bread for 100 years, priding yourself on the craft. Then a competitor opens next door with a machine that produces bread that tastes almost as good, at a tenth of the price, 1,000 loaves an hour. That's what happened to Switzerland. Between 1970 and 1988, the number of Swiss watchmaking companies collapsed from around 1,600 to roughly 600. Employment in the industry cratered from 90,000 jobs to around 20,000. It's remembered in the industry, without exaggeration, as the quartz crisis, and it very nearly ended Swiss watchmaking as a global force forever. Here's the lesson buried inside the collapse, and it's the lesson that saved the industry. Switzerland couldn't win a war on accuracy or price. Quartz was simply better at telling time and massively cheaper to make. So Swiss watchmaking had to stop competing on function entirely and pivot completely to competing on meaning. A businessman named Nicholas Hayek, who would later found the Swatch Group, understood this shift before almost anyone. He engineered a merger of two failing Swiss conglomerates in 1983 and launched Swatch, colorful, playful, disposable plastic quartz watches, to compete for the low end of the market on Japan's own terms. But simultaneously, he used the profits and stability that Swatch generated to protect and reinvest in the high-end mechanical brands the group also owned, brands that would go on to double down on heritage, craftsmanship, and status rather than accuracy. That decision, made in the wreckage of a near-extinction event, is the entire reason the luxury mechanical watch industry exists in its current form today. It didn't survive by getting better at the one job a watch is supposed to do. It survived by convincing the world that job was never the point. And this changes everything about how you should think of every luxury watch ad you've ever seen. Now let's look at the second case study, because it shows what happens when this business model meets a genuine financial shock rather than a technological one. In 2020, the global pandemic shut down watch boutiques worldwide, halted travel, and closed the Swiss borders that most manufacturing depends on. Swiss watch exports fell by roughly 22% that year, one of the steepest single-year declines in the industry's modern history. Analysts inside the industry openly worried this might trigger a second quartz crisis, but from the demand side this time instead of the technology side. Then something strange happened. Instead of collapsing, the secondary market, the resale of used luxury watches, exploded. With boutiques closed and travel impossible, wealthy buyers, who couldn't get their names off waiting lists at official retailers, turned to the resale market instead, and demand there went vertical. Watches that retailed for $10,000 were changing hands online for $20,000, $30,000, sometimes $40,000 during 2021, as low interest rates flooded markets with cheap capital and collectors, along with a wave of new speculators, treated luxury watches almost like a stock ticker. An online marketplace called Chrono24, essentially eBay for luxury watches, saw its watch transaction volume estimated well into the billions of dollars during this period. People who had never cared about watchmaking were suddenly buying steel Rolex and Patek Philippe pieces purely as investments, betting the price would keep climbing the way it had for the 2 previous years. But here's where the story turns, because bubbles, by definition, only move in one direction until they don't. By 2023, as central banks raised interest rates aggressively to fight inflation, that speculative capital evaporated almost as fast as it arrived. The secondary market for luxury watches fell sharply, with some previously red-hot models losing 30 to 40% of their peak value within about 18 months. Traders, who had bought a watch purely as a speculative asset, rather than because they actually loved it, were suddenly sitting on losses on something they couldn't easily liquidate, because unlike a stock, you can't sell half a watch, and the buyer pool for a $40,000 object is a lot thinner than the buyer pool for a share of Apple. The lesson from that crash is one that every serious collector in this industry will tell you, and it's almost philosophical in nature. A watch is genuinely one of the worst assets in the world to buy purely for financial return, because its value depends entirely on desire, and desire is fashion, and fashion is fickle. The watches that held their value through that correction weren't the trendiest pieces chasing hype. They were the ones with the deepest, slowest built brand heritage, the Pateks, the vintage steel sports Rolexes, the pieces that had been desirable for decades rather than months. In other words, the fundamentals of this business haven't actually changed since the quartz crisis 50 years earlier, meaning outlasts hype. Every single time. So let's talk about the risks that sit underneath this entire industry, because they're bigger and stranger than most people realize. The first risk is counterfeiting, and it's a bigger business than most people assume. Some industry estimates suggest more fake Rolexes are produced every year than real ones, with counterfeit luxury goods broadly estimated at somewhere north of $500 billion globally across all categories. Every counterfeit watch sold doesn't just steal a sale. It chips, very slightly, at the exact thing the entire industry is selling: exclusivity and trust. The second risk is generational. Younger buyers, broadly speaking, show less attachment to physical status symbols than previous generations, and more interest in experiences over objects. If that shift deepens over decades, an industry built entirely on inherited desire for tangible heritage could face a slow demographic headwind that no marketing budget can fully reverse. The third risk is technological, and it's the quiet irony sitting underneath this whole story. The smartwatch market, led by Apple, now sells more units globally in a single year than the entire traditional watch industry combined. Apple Watch revenue alone is estimated to exceed the combined annual revenue of the entire Swiss watch export industry. The machine built to tell time, genuinely well, using satellites and sensors and health data, has already won the functional argument completely and permanently. And yet the luxury mechanical watch industry keeps growing anyway. Which brings us to the advanced concept that ties this entire story together, the one thing you need to understand to really get why this business works. A luxury mechanical watch, in the year 2026, competing against a device that can call an ambulance, track your heart rhythm, and never lose a second, has fundamentally stopped being a tool. It has become the last remaining piece of purely symbolic manufacturing that most people will ever own. It is jewelry with moving parts. It's a small, silent argument you make with your wrist about who you are, who you've been, and sometimes who you hope to become. That's not a flaw in the business model. That is the business model. Every hour of hand finishing on a movement nobody but a watchmaker with a loop will ever inspect. Every year on a waiting list. Every dollar spent on an ad campaign about legacy instead of accuracy. All of it is manufacturing a feeling rather than a function. And it turns out human beings will pay almost unlimited amounts of money for feelings, especially the feeling of having arrived somewhere other people haven't. So think back to the number we started with. $400 to build. $38,000 to sell. A waiting list years long, for a product that could be made faster if anyone actually wanted to sell more of it. That gap isn't inefficiency. That gap is the entire industry. Because owning a watch company, really owning one, was never about mastering gears and springs. It was about mastering something far harder to engineer. Convincing millions of people that a piece of metal on their wrist says something true about who they are, and then having the discipline to never, ever make enough of it to let that feeling fade. Somewhere in Geneva right now, a craftsman is finishing a movement that will take him weeks to complete, on a watch that won't reach its buyer for